Is Target back? Looking at the stock today, up 18% after reporting earnings. A lot of investors are thinking that is the case. I'm Jason Hall. This is The Smattering. We're going to take a closer look at Target's earnings, how the business did, what the trajectory is, and see if we can reach a conclusion about whether or not Target has reemerged as a stock that's worth buying right now. Before we get into that, this video is sponsored by The Motley Fool. If you're looking for even more great stock ideas, go to our special link. Go to fool.com/The Smattering. The Motley Fool is going to give you its 10 best stocks to buy right now. Be sure to check that link out after the video. All right, let's get to it. First things first. Again, this is pretty much real time right now. You see the stock is up a ton. It's up 18% so far today. If you take a look, it's still down. It's still down about 13%. We saw a little bit of a run earlier this year. It's still down 28% from that period. And if we look at from the high over the past 3 years, the stock is still down by about half. But I will say, if you're looking at the stock today, if you bought it more recently, you're probably feeling pretty good about yourself. Now, the question, is this just a one-day pop? Is this what they call the dead cat bounce, where this is still a business that's struggling? Investors shouldn't get too excited about what's going on right now. Let's take a look at the company's results, what they reported, and see what we can learn. So Target does an infographic that they share. They don't have slides. And I like the way they lay out the infographic because it does focus on some things that are pretty important. And you see right here at the top in this red bar, they really hit the things that you want to focus on, like the main things to focus on. So again, Target, large retailer, very well-established presence, still growing its store footprint, but it's a pretty mature business overall. So comp sales is super duper important. This is a metric that tells us about the health of a retailer. It also, again, for these large retailers, it also is a little bit of a look at kind of the macro environment. So Target, you see comp sales, and this is revenues at stores that have been open over a year. So again, comparable, there's again, the existing store base. So it doesn't include sales from any newly opened stores, down 4.9%. Now that's includes all their e-commerce sales and everything. And then store comparable sales, again, that's stores just in the sales, just in the store. And then digital comparable sales includes is their e-commerce business. So you look at it initially, it's down 5% basically for overall, 4.6% down it's in the stores, and down 6% in digital sales. That's not great, right? No, it's not great, but there's a couple of key things here. This is a broad trend. We're seeing, if you go on the Wall Street Journal's website today, you'll see one of their cover stories in their finance page talks about retail sales being down right now. And this is, so this Target's not alone with this. So it fits with the broader trend. The bigger concern, and number one, I'll say this, its revenues were more or less in line with expectations, close enough that the market is, again, look at the stock price, investors more or less were expecting that. The big thing that's a positive on the far right over here, $2.10 in GAAP earnings per share. That was up 36% year over year. Again, this is a company that has seen its earnings take an absolute dive from the peak back in, if we go back to say 2019, and you saw the huge run up during the pandemic, we've seen its earnings absolutely take a dive from that peak, right? So again, getting back to what the company is telling us, this is great. How did they do it? That's the big question. How did they do it? So a big part of it is right here, this 14% reduction in inventory, reducing their inventory versus the year over year period. And we know, again, back in all of this period here, when their peak earnings, the pandemic and post-pandemic run up, and then earnings started to decline, a lot of this decline was because they had too much inventory and they were in a situation where they started to have to take some pretty significant discounts, right? And that discounting gutted their margin. So at an operating margin rate, so again, that's your gross margin minus all your operating costs, operating margin 5.2%, up from 3.9%. You might think 3.9 to 5.2, that's not very much. But again, if you look at it on the percentage basis, that's huge. Moving from almost 4 to over 5, that's a better than 25% improvement in your operating profitability. That is a huge gain. That's how you get a 36% increase in earnings per share. They also continue to spend money to improve their operations, driving out costs and really focus on being lean. You put all those things together and the business is getting healthier. Okay, so we see some things that are good and not so great. The revenue decline, the comps decline, not great, right? We have to admit that's not a great thing to see. But again, based on everything that's going with these large retailers, it's what's happening right now. It's just the reality of what's going on. The bigger focus on profitability, that's a great thing to see. That's a big positive. There's no doubt about that. And again, especially for a retailer like Target that has been around for so long, this company's operated for decades. They've learned from some of their recent missteps. They've done a better job of getting their inventory in line. I think that does bode relatively well moving forward. Now, they're about to move into their holiday period. Obviously, this quarter ended in late October for them. The way their fiscal year lines up is a little bit different than many others. So we're really about to start finding out how well the company is executing and if they're able to capture better sales as we get through that all-important holiday season in November and carrying through December and even into early and mid-January. There's a carryover effect there during the holidays for sales for a lot of retailers. So we're going to learn a lot more about that. The last thing that we need to talk about valuation. Is this a business that's worth buying? We looked at the stock price a little bit. We know, again, it's still down by half from that peak period where I think undeniably it was incredibly overvalued based on very high expectations from the growth of its e-commerce business and the results that it was generating during and directly after the pandemic. So I'm going to pull up a couple metrics here on the screen and we can talk about it just a second here. So when you have a big retailer like this, a well-established company with a long track record of profitability, using something like the price to earnings ratio is the smart way to go. The PE ratio makes sense. So you look at it and you're like 18 times, that still feels a little bit expensive. When this company was growing at a higher rate, it traded for a higher PE ratio. So you're like, maybe that seems like expensive, especially if it's not able to really turn the corner and bring revenue growth back to where it was before. But I think maybe a little bit deceptive. And again, because we look at its earnings per share, again, earnings per share are still, I'm going to look at a 5-year chart instead of the 10-year chart. Again, we're still way below that peak period. When can it get back to these levels here, $13 a share in earnings? I think it can. The bigger question is when, because if it takes 15 years to get to those level of earnings per share, maybe today's price isn't a very good price. But I do think that its ability, as we saw, focusing on efficiency, getting leaner, getting those profits back to its margins back to those better levels, I do think that there is a ray of hope here. Again, over the past four quarters, it's earned $7.28 per share. That's a little bit more than half the earnings per share that it earned at the peak. So again, using a baseline of, let's say, $10 a share, there we can go with that. That's not too off from using its most recent quarter. Using that $2 a share that it earned in this quarter is just a basis for a run rate. We use that for over 4 quarters. That's $8 a share. Factor in some growth, business stabilizing, revenue growth returning. Let's say we can get back to $10 a share, okay? The stock trades for about $130 a share today. So at $10 per share in earnings per share, you're looking at about 13 times price to earnings. What does that mean over the long term? 13 times price to earnings, again, 16, it's this line right here, 16. We're looking at, man, that starts getting really attractive in terms of comparing it to its historical valuation. Put it all together. Business looks like it's stabilized. Is it ramping back up to growth? It's going to take some time. The economy's got to get to the point where consumers are ready to go spend more money at Target. We're seeing consumers pull back right now, okay? But the company's lean. It's getting its operations better. It's being a better buyer of inventory. So it doesn't have to discount as much. Stores run more efficiently. Operations are better, more profitable. Thinking about the valuation, again, not just based on where the earnings have been the past 4 quarters, but the trajectory of where it looks like its earnings are going to be. Looking forward, the market's always looking forward. Today's stock price to me still looks like a pretty attractive entry point if you're looking at Target stock.